Good afternoon, everyone. My name is Ryan Rees, Director General of the Federation of European Securities Exchanges, and I'm very happy to moderate this afternoon the panel on the European ESG Action Plan. And we'll discuss a little bit EU Sustainable Finance Regulation. We're going to discuss the latest developments in financial services policy, legislative measures, as well as corporate governance practices in Europe. It's a pleasure to welcome a very distinguished panel here. First of all, Gabriela Figueiredo Dias, chairperson at the CMVM, the Portuguese Securities Commission. Then we have Robert Adamczyk, senior environmental advisor at EBRD. Robert Ansari, Executive Director and Head of the Middle East MSCI, and Andy Petit, Director of Policy Research, EMEA Morningstar. And just to set the scene very briefly, I think if we look at the economic fallout of the COVID-19 pandemic, aligned with very high levels of public debt in Western countries and a continued overdependence of the banking sector, I think we were, even before this crisis, very certain we needed to develop our capital markets even more. And I think this is compounded by the biggest crisis, much bigger than COVID, that we're facing, and that is to say climate change. And Europe, I think, wants to be at the forefront of being a pioneer and a trendsetter to manage this transition to sustainable investments. Capital markets are at the core to finance that transformation and to enable transformation by really allocating capital to the most efficient use. And we all know at the end, sustainable returns can only be produced by sustainable investments. But what we'll discuss on that panel is really what global and European framework do we need? How do we measure the E in the environmental, the S, the social, the G, the governance, and what's happening in Europe and what effect will it have on other geographies? With that said, I would ask Gabriela to set out a little bit the ESG concept and efforts and challenges that we see, I think, in Europe as well, I think more on a global scheme. Gabriela, the floor is yours.
Thank you very much, Rainer. Good morning, everybody, ladies and gentlemen, and thank you to the Arab Federation of Exchanges for this kind invitation. It's a real pleasure to meet you here today with these very distinguished panelists and speakers. And it is also an honor to participate in this event and share some experiences on this very inevitable and very stimulating subject, which is sustainable finance. But I'd start to say something about what is sustainability and how does it fit in the financial markets. In broad terms, sustainability is a concept that aggregates the so-called 3 Ps: people, planet, and profit. And these are all the sides of the same coin: economic viability together with environmental protection, and both of them coupled with social equity through some sound organizational models. There isn't one without the others. The trick is to find a balance between an economically viable business that generates wealth for the people owning the business, the people working in the business, and the community that is home to the business, including the planet. So sustainable finance refers to the process of taking due account of environmental, social, and governance, ESG, considerations when making decisions in the financial sector, leading to increased longer-term investments into sustainable economic activities and projects. Those considerations may be of very different nature, and I can mention here a few: climate and biodiversity concerns, pollution prevention, circular economy, inequality, inclusiveness, labor relations, human rights, management structures, gender balance, executive remuneration. These are only a few, but in a word, they are all factors that play a fundamental role in ensuring the inclusion of social and environment considerations in the investment decision process. So how is sustainable finance being addressed in the European policy context? The European Union's policymakers have put sustainable finance at the forefront of their priorities, and they are strongly supporting the transition to a low carbon and sustainable economy and the building of a financial system that supports sustainable growth. This strong commitment to sustainable finance is based on the conviction that sustainable finance has a key role to play in mobilizing the necessary capital to deliver on policy objectives of the European Green Deal and the European international commitments on climate and sustainability objectives. So, in the European Union's policy context, sustainable finance is about taking the financial system to support economic growth by channeling private investments as a complement to public investments into the transition to a climate neutral and just economy, while reducing the threats to the environment and contributing to mitigate and overcome social and governance issues. So this topic has a cross-cutting nature, both in terms of economic sectors and geography, and this is why the European Commission and international organizations like ESMA and IOSCO have so quickly and rightly jumped on the board of sustainability train. In fact, the European Union and specifically the European Commission and ESMA are working on a policy and regulatory framework on sustainable finance, which is progressing very quickly, even if not without difficulties. ESMA, which, as you know, is the European Authority for Securities Markets, has identified the ESG risks as one of the main risks for 2021. And so we are working at ESMA level on the impact of climate risk in the market, with a particular focus on asset management supervision. And we are coming to the conclusion that asset managers have probably the most important role to play in preventing the risks of greenwashing, but mainly in acting as fundamental drivers of the shift to sustainable business models at the firms in which they invest. ESMA is also playing an important regulatory role in sustainable finance, as it is responsible for drafting regulatory implementing standards and providing technical regulatory advice to the European Commission. The Non-Financial Information Directive, the Disclosure Regulation, and the Taxonomy Regulation are the most relevant regulatory outcomes so far and important cornerstones of the European and, I dare say, worldwide regulatory framework on sustainable finance. The main objectives of this regulatory framework on sustainable finance is to avoid the so-called greenwashing and to ensure appropriate information to investors, while at the same time setting up regulatory incentives to market participants to contribute to this purpose. But I must also mention the work that is being undertaken by IOSCO that is also taking protagonism at an international level. There are work streams on sustainability disclosures by issuers and of securities and by asset managers, and on the role of ESG data and rating providers. The IOSCO board is also committed to working with the IFRS Foundation trustees and other stakeholders to advance their priorities. In fact, sustainability is one of those topics where we have both policymakers and policy shapers working together. All in all, this is all about trust and confidence. When investing in a business, confidence is essential, and capital markets in particular are built upon trust and confidence, which in turn rely heavily on transparency and information. And in such a world, cross-cutting and wide subject like ESG, information that is material and comparable is key. For years, we have been talking about financial information and non-financial information as if they were separate and different, very different concepts. But truly, is there one without the other? It is not enough anymore knowing whether a company has made a certain profit and the amount of that profit. We also need and want to know the conditions and circumstances behind it and the consequences for the people and the planet of this way of making profit. Quality, consistent, and comparable information concerning sustainability must be made available to investors in a clear and accessible manner to ensure their good understanding of options and risks. This invokes two dimensions of information, the one that is disclosed by companies and the one that is provided by investors. When discussing sustainability, we are no longer talking about the distant future because future is already here. And I'd like to end this intervention with the following idea. The simplest way to conduct a sustainable business is asking ourselves the question, what legacy do I want to leave for future generations? And then act accordingly. Thank you very much. Rainer, you're mute.
I'm on mute. Now, what legacy to leave and keeping people, planet, and profit in mind. I think was a very impressive introductory statement. Thank you, Gabriela. Robert, maybe you could shed a bit of a light on the EU legislative agenda. And we love acronyms, SFRD, NFRD, MIFID. So I'm sure our viewers probably would appreciate a bit of a translation of what all these acronyms mean.
Okay, thank you very much, and thank you, Gabriela, for the introduction. There's two things, first of all, to consider. Environmental, social, and governance issues are not something new. They have been around for a long time. I think a lot of us were professionals working for a long time will just see it as repackaged in some ways. But it is and I wouldn't say it's a buzzword, but it is a topic which we'll see more or less every day now in the FT or in the discussions at the boardroom. What is ESG, how it's actually being implemented. And it's not just the environment, we all know about climate, and that's of course a key area which has been pushed very hard, particularly with the climatic changes that are taking place, and governmental commitments. But it's also the biodiversity side that is coming in. There's also important, and not only pollution and prevention. The social issues we have had for a long time, not just the health and safety, but it's actually the workforce. And in the post-COVID world, I think the workforce, how we actually, whether we're good social corporates and have a social heart, is going to be a fundamental area to judge actually how people perform and how actually companies perform. And the governance, of course, has always been an issue. How do we govern? It's not just anti-bribery, child labour, but these issues need to be reported. So the EU has embarked together, I think, really under the pressures of G7, but now G20, to address requirements. And I think I'll just present maybe one quick slide, which I hope I can share, on the architecture that is being developed. And the Commission has been at the forefront in our view of a lot of the activities. But this is not just the Commission, and it's not just Europe. I think if you can see my slide, just hopefully yes.
Not yet.
Not
nope.
yet. No. Display settings. Well, I should say, taskbar. Okay, so I'm struggling. Share, that's it. Should be now.
Yes.
And
yes,
so apologize. So very quickly in the introduction, the EU has developed a sustainability framework. This has been clarified in March 2018, actually with the setting out of an action plan in terms of sustainable finance. And this is an area which has been growing and developing very fast. But it's, as I said, not new. We had the non-financial disclosure requirements already in 2014. CSR requirements were much before that. But we have a new EU climate law. It all sort of evolves around climate, but I'd say it's not limited. In fact, includes all issues. We have a European Green Deal, again, to focus particularly on investments in the green side, as Gabriela has said, and I think we'll be discussing in the panel. But the Sustainable Finance Action Plan is a moving target. So therefore, there will be a new action plan disclosed at the end of April. The non-disclosure financial regulations will be, in fact, replaced by a sustainability reporting directive, which will be introduced by the end of the year, but already in April as a draft, which will again oblige companies in terms of disclosure. And we also have the financial reporting, the sustainability reporting directive, that is SFDR, and I have a separate slide, but I think this is too much to show. The number of acronyms is growing, but it's also the requirements of investments. We have the green bond standards, we have sustainability linked bonds investments, and all aiming to ensure that we define what is green. And for that purpose, the EU taxonomy legislation is coming in to define what will enable us to meet these green objectives. And there's 6 environmental objectives, social objectives being developed, is to ensure that there's a common mechanism and a common framework to define what is green, how to report that both by corporates, but also by asset management and the financial sector, to enable both the targeting of investment, but also to allow investors and the general public to understand what is meeting the objectives, which basically 2030 and not net zero targets for 2050. And this area of net zero emissions is going to be a fundamental shift in how companies operate, particularly in the fossil fuel side, as we will be aiming to many ways to reduce the reliance on fossil fuels significantly, to ensure we meet our climatic targets. And to do that, the focus is for companies to assess the risks and present to investors how they plan to achieve that. And before we go into the discussion, there is also a lot of work internationally. And I think this has to be raised as well. This is not just an EU project. There's an international panel for sustainable finance. With the change in the US will be highly active in that view. It's already indicating that it wants to be very extremely active. But both Russia, China are also developing their own taxonomies. So this is actually a common worldwide theme and a worldwide approach, which we will see in the culmination, I think, as Gabriela said, of common standards and common benchmarks. And the first way to address both climatic, environmental, social, and governance issues is to develop a common systematic way of reporting, disclosing, and ensuring that there is trust built up between all shareholders, but particularly in the financial markets. So I think with that, I'll pass on to the panel, as the aim was just to sort of outline the introduction, and it is a topic which we could, I think, speak for a number of days, but we have not that much time.
No, but I think you did a very good job shedding a bit of light in the many acronyms, and I think laying out what is green and how to report it. And again, that is the key question. Let me go to Rob Ansari, and maybe you can comment a little bit how ESG is being viewed and implemented in the region. I think that probably would be very interesting for our viewers.
Yeah, thank you, Rainer, and good afternoon, good morning, everyone, and thank you to the AFE for having me here today. Without wishing to steal too much of the next panel, which I think talks a lot about the ESG in the local region, it is interesting, and I find this topic fascinating myself, but it's interesting to see how the European markets together are trying to build a coherent set of rules. I think one of the main challenges that many of the Middle Eastern markets will face is saying, okay, we're going to adopt, and as you just said yourself, Rainer, the Asian way of thinking about sustainability, or we're going to adopt the European way or the US way. So I think one of the main challenges that the Middle East faces for ESG is what kind of coherent set of rules they need to follow. And I think a lot of the DNA is sort of being created as we speak, right? So many of the, in fact, all of the regional exchanges are part of the Sustainable Stock Exchange initiative, which I think is a fantastic thing. But ESG, if you want to call it ESG 1.0, really has been an adoption of thinking about a risk mitigation. So what are the risks from a portfolio perspective for not adopting and following certain ESG standards? The second incarnation of ESG in the region is to think about, okay, what are the opportunities? And I'm kind of dumbing it down. But as it relates and pivots back to the exchanges, however, and also the regulators in the region, there is now a real need for there to be some set of common standards. So not just thinking about each individual's own market around ESG, is the data is gathered and then introduced into the ecosystem, but then having a consistent set of common rules. And I think so. ESG in the region right now, I would say it's at a turning point. It is front and foremost in most of the conversations that we have. We all know that 4 of the main sovereign wealth funds in the region are part of the One Planet Sovereign Wealth Working Group. That gives a sense of just how important climate, at least, is across the region. And clearly, there is a lot of concern in a positive way about greenwashing. All these markets that at least I sit in are all driven by commodities. They're all commodity, either directly or indirectly funded, whether you are an oil company or whether you're a bank funded by an oil company. So there is a lot of concern about hypocrisy and not wishing to be seen to be not practicing what you preach. So the way that ESG gets adopted, I think will be done in a very careful and transitioned way. But I think there'll be cries of some form of consistency and some form of coherency with how ESG gets adopted across the regions, not just for consumption in the region, but for the eyes of the investing world who will come into the region to invest.
Well, thank you very much. And maybe to call on our last panel to comment, a panelist, Andy, to comment a little bit on, I think, the issuer disclosure and avoidance of greenwashing. We've heard that, I think, by all the panelists so far, but I would think how to get that information out and how to get it out in a, as you were just saying, Rob, in a consistent fashion, that is probably the biggest challenge. Andy.
Thanks, Rainer. Yes, indeed. I think that the whole information flow is a fascinating part of this, because to a large degree, I think the plan that Robert outlined is very dependent on that information flow across various different stakeholders in the chain. And one of the things that I think the EU Action Plan does quite cleverly is to create a series of interdependencies between different actors. So, for example, investment advisors must start to factor clients' ESG preferences into their suitability assessments and their recommendations, alongside the more traditional factors of risk tolerance and capacity for loss and things like that. So for them to get the information they need, they become very reliant on the asset managers that are creating investable products, who will in turn need that information from the issuers in which they're investing. So that's a pretty kind of strong force putting that pressure on. And since just over the last 3 weeks since the SFDR took effect, we've been busily collecting data from asset managers, and the early indications are that around 20% of the European landscape are classifying themselves as either environmental, social, or sustainable funds. And if you look at that on an asset basis, it goes up to around 25%. So extrapolating that out, you could be talking about in the order of 2.5 trillion euros that are very dependent on this information from issuers. Beyond that, you've also got people like insurance and companies, banks and asset managers having to factor sustainability risks into their capital requirements. So another stakeholder with a big stake in this ground. The good news, I think, is that overall we're seeing disclosure rates improving. Our Sustainalytics group that aggregate a lot of this information from corporate issuers are seeing rates of around 65%, which is better than it was, but still a long way from where it needs to get to. And that naturally masks quite a variety from pretty comprehensive disclosure now of companies about environmental policies, but at the other end of the spectrum, pretty limited disclosure of things like gender pay. The second challenge, I think, is on the timing. And this, I think, is kind of unavoidable with such a wide-ranging plan that Robert outlined. You've got a challenge in that, for example, the taxonomy disclosures will start being made by companies at the end of this year, but at the same time, investment funds need to making the same disclosures. And so you've kind of got in the early days, I think, a challenge for people to get that information. But I do see a very positive momentum building, and as some of the other speakers mentioned, there's global organizations really getting involved with people like the IFRS Foundation and IOSCO. So yeah, things are looking positive.
Oh, very well. But let's maybe talk a little bit about issuers and investor and take a few minutes to think about what risks, opportunities, and challenges we're really seeing in that area. If I listen to what you're saying, you know, this is a challenge. As an asset manager, I have to have the data. And obviously, the issuer doesn't even yet know what he will need to report under the non-financial reporting directive and how this can be made consistent. So I think this is a little bit of a challenge probably on the two sides, how to get the reliable information in a timely manner so it's not too high of a burden to issuer. And on the other side, for the investors, ideally have 100% of the reality today. And maybe, Gabriela, can you give us a little bit a sense of timeline and how you see that, how to bridge that gap between issuers and investors? Gabriela, you're on mute.
My turn. Thank you. Well, on the timeline, I'm afraid I cannot give you an exact timeline. What I may tell you is that we are working very hard at ESMA level and the European Commission as well, and also at the individual level of each NCA's national competent authorities to make sure that until the end of this year, we will have somehow a strong and robust framework already in force. But I must always warn you that other regulatory developments will come in the next few times, along with the SFDR, the Sustainable Finance Disclosure Reporting and the Taxonomy Regulation. The next years will be marked by relevant adjustments in some of the most important regulatory pieces of market regulation in Europe, from prospectus and disclosure of non-financial information to investor protection, including MiFID, and we get back to the acronyms, MiFID, UCITS, and AIFMD, and revisiting the concept of fiduciary duties, which is a very important issue. But anyway, on taxonomy and SFTR, I'd say that I am aware of the paramount role of regulators in this field, but the focus should be taken on creating the best regulatory and supervision conditions to avoid unnecessary barriers to the integration of ESG factors into investment models and investment choice, and ensuring that investors and other market participants have the necessary information, which has to be accurate, clear, complete, and comparable. So the most important challenges are ensuring that everyone clearly understands what is expected from them, that there is convergence in the supervision of the application of the new legal framework, and at the same time enabling some degree of proportionality to take into account national and regional specificities. So we have to have simple, clear, and proportional and harmonized regulation, harmonized and effective supervision, and avoid some traps, which are there for certain, the uncertainty trap, regarding indicators, metrics, and their validation by external auditors, which is also important, but also avoiding the trap of thinking that everything can be measured. Of course, we need metrics, we need to measure, but we need to evaluate in a more general approach. The expectations gap as well, which should be avoided because there could be unreal expectations, in particular that the current approach will be sufficient to limit climate change and other sustainability issues. The greenwashing trap, and we have been through that, and so on. So, on the NFRD, the non-financial reporting directive, of course, there are balances and checks and balances that we have to address. It is on the one hand important that the NFRD enlarges its scope, requiring additional entities to disclose non-financial statements. Of course, this will come at a price, the price of more burdensome and onerous regime, but also there is the advantage of getting more information from a larger number of entities, which may be positively embraced by stakeholders, namely by investors, and thus promote the access to those companies to capital markets. If more detailed and stringent information is required to be disclosed, of course, we will face additional challenges to collect the necessary information, but on the other hand, the quality of the information provided to stakeholders will be enhanced as well, as it will be more comprehensive, comparable, reliable, complete, and thus it will reduce the current quality gap between financial and non-financial information.
Yeah.
So one more thing, if the revised NFTR will require, and I think so, mandatory assurance of the non-financial information statements by auditors, or third parties, but auditors mainly, that will bring additional costs to issuers, of course, but can also, and will for sure also promote additional reliability of the information, which is also important. And I think it's the most important, these are the most important topics.
Yeah, no, thank you. And maybe Robert, let me pick one thing up. And Andy also spoke about greenwashing, and I think everybody mentioned the term, but maybe that is worthwhile a little bit explaining greenwashing here a bit better. And I think Gabriela just said accurate, clear, and comparable data is needed. Obviously, it is not yet available. So you maybe want to share your views on greenwashing. What is it, and how to avoid it?
Okay, if I may, I think first of all there has been a lot of data, and it depends on companies what they disclose. There's a lot of guidance on the ESG or CSR and information that has been provided, but it's just not uniform. The key area that we're now seeing is, of course, the TCFD, the Task Force for Climate-Related Financial Disclosure, which is being incorporated, I think, worldwide as the framework which most companies will implement on climatic information. And that, of course, is going to at least set a certain benchmark of how to report climatic information and how to actually assess data and how to present. So we as the EBRD are working with the Warsaw Stock Exchange right now to develop a guidance on what ESG disclosure should be over the next years. But greenwashing is, of course, because it's a business opportunity. More and more money is going into this area, and people will want to sell products which are viewed as green. If we look at the number of funds that suddenly are changing their names or being ESG linked, is a symptom of this. And therefore, it's a question of not just the corporate governance of the company, or that it actually is compliant or doing the right things or the CSR issues, but does it have a real set target in the right way? So if I look at the coal mining, for instance, let's take the extreme of a listed coal mining company, it can have a fantastic reporting, non-financial reporting framework. It can have fantastic governance, health and safety, and social aspects. However, this company is unlikely to survive in Europe post-2030. And therefore, what is the value of the company today, with the market prices quite high and actually coal still in demand? But in the next 10, 15 years, the view will be in Europe that this market will disappear. So this is really what we're trying to also do, is ensure that investors have the right level of data of what the future holds. We're already seeing that the European Investment Bank, for instance, will not invest in gas, never mind coal. So this area of what assets, the value of assets, of stranded assets potentially being subject due to climatic changes, is actually has a financial impact. So it's not just about saying the bees and the birds and whether you have good social policies and whether you have the right level of gender representation at, for instance, the board. It's, are you financially a viable company in the years to come, post 2030 particularly, when the various international agreements take shape and when there will be changes. And the regulators will be just pushing to ensure that these changes are put in place.
place. Absolutely. Rob and Andy, I probably will ask you the same question. I think you both, coming from Morningstar and MSCI, play a big role in leveling that divide between the consumers of ESG information and the providers, i.e. issuers and investors at the end. You maybe briefly want to comment on how you see that role and what can you do as participants in actually provide better information flow there?
Sure, maybe I'll go first, Andy. So look, MSCI sits as a middleman between the issuers and the investors in those issuers. And look, SFDR has done a few things, but it probably shone a light on just how detailed an amount of information is required from corporates. You mentioned yourself, Rainy, that you're an asset manager. And I think the first incarnation of SFDR required something like 30 different inputs. And if we think about what SFDR is supposed to do, essentially protect investors. One of the first things those corporates do is say, look, do we then collect information like biodiversity? Do the corporates, all around the world collect water usage? Do they analyze their electricity bills in the way that they should? So a lot of what MSCI has to do is translate some of the things which are not necessarily not important, but they almost need to translate them into financial metrics to say, okay, so this company has this kind of biodiversity agenda or strategy. This company versus that company has a different water consumption, and so on and so forth. And it becomes less of an absolute measure, which I think SFDR does, and starts to become more of a relative measure. So it's not necessarily a binary argument of this company is bad, we don't invest in it, and this company is good, we do invest in it. It becomes more of a gray area where you say, okay, well, on a relative basis, these how we'd rank those different companies. But so I think the challenges for the issuers are, do they have the information to gather? Do they collect the information that they need to present? And then the investors say, well, that's great, we have all this huge wealth of information, but how do we consume this and how do we consume this information in order to make an investment? So a lot of what MSCI does, and I'm sure Andy will allude to this too, is sort of translate all these sort of non-financial metrics into metrics which enable investors then to say, okay, I can now make a meaningful and informed decision to invest in a company. So I think a lot of the challenge is not only the burden on the issuers, but just how to translate that into meaningful information so investors can then go make an informed investment.
Andy, you want to go?
Yeah, I guess unsurprisingly, I certainly agree with Rob, and that is a huge challenge, is how do you make all this vast quantities of information intelligible for investors to actually use? And I think one other factor to mention is just around the concept of materiality. And so really only or seeking to get the information that's most important to a given industry in which a firm's operating, rather than a lot of additional metrics which may be very inconsequential in the grand scheme of things. So.
No, very good. We have, I think, 7 minutes left in that panel, and I maybe would give everybody the opportunity to sort of do a closing statement, and I probably would combine that with a question. I mean, if I look a little bit, sustainability obviously goes hand in hand with governance, the G in the ESG, and I think it requires companies to change, and I think Europe has seen. Not only Europe, but we've seen quite a few of our corporate scandals. One, I think, where governance was at the core just recently, Wirecard, and Gabriela looked at that quite intensively at ESMA, of course. But I think that underlines how important good governance is, and how governance, I think, is needed to change to a more sustainable economy. NASDAQ is considering in the US to actually require companies to report on their diversity within the boards. So I think there's a lot happening on that governance front. So maybe if you would, in your final closing words, concentrate a bit on how do we make sustainable governance right for companies. Gabriela.
Thank you very much, Raina. This is an issue and a matter that is very close to my heart, but I would say it's very difficult to say in 1 minute what I think about it. But There is something I'm sure is that sustainable corporate governance will possibly, or will certainly require companies to make changes to their governing bodies, processes, the way they communicate with stakeholders, and ultimately their corporate purpose. And the first aspect that comes to my mind, or the last one in this panel, has to do with the fact that sustainable corporate governance should promote a broad reflection within companies about their purpose and the role that the directors should play in order to achieve this purpose or these goals. So the main challenge, I think, is to make corporate leaders and shareholders overcome the false opposition between shareholders and stakeholders' interests, because shareholders are stakeholders as well, as they hold the same interests of all the stakeholders and suffer the consequences of the company's departure of people and planet purposes in the manner of they achieve profit-only goals. So, considering the interest of shareholders and other stakeholders as well, companies will need to decide what they can do, or what should be expected from their directors, and make the necessary adjustments to ensure that the company doesn't stray away from its purpose. This is the very nature and meaning of corporate governance, making business fit for people and for purpose.
Very well. Let's try to be very brief, everybody. 1 minute, because I think we're running out of time. Robert.
Well, from my side, the legislation is coming. The requirements are there. You need to, and I think all, both the financial sector, investors, but also the corporates need to prepare. And the question that we have, or the support that is needed is, are you prepared? Are you ready? This is something that is going to happen and you can't ignore it. Particularly the climate disclosure information and setting out strategies, how you're going to deal with that is essential. The biodiversity impacts are going to be as well important. There's a new task force for nature financial disclosure being developed to ensure that biodiversity is in place. And this is no longer going to be nice to have or a hobby. It's going to be a regulatory requirement. International financial institutions will require it. And I think also most investors, particularly institutional, but not only. In the current day, we're seeing that the young generation is actually looking at this more than the older generation. And they will be looking at what they buy, how they buy, in terms of the environmental and just general ESG footprint. So it's going to be important. So just prepare.
Andy. Thanks. Andy?
Yes, so very quickly, yeah, I think boards just have to get used to being more and more open and communicative about their business direction. You've got more investment managers taking an engagement approach, wanting to talk to them directly. You've got more and more shareholder resolutions being raised, and so that whole environment is becoming more and more interactive.
Great, Rob.
Yeah, look, I think governance is key to everything, as you mentioned, Rainer. When I look back at the Volkswagen scandal, people remember 11 million cars were wrongly installed with fake numbers. So, but that was all underpinned by governance. But I'll probably sum up by a local flavor of governance and transparency, and that is to say, a lot of what is required across the European Union, when that translates into things like the Middle East, will be a challenge, mainly not because of a design not to do it, but because of the cultural nuances of many of the family offices here that want to list or are already listed, but their boards are made of family generations of people. They're typically one or maybe two families and so on. So I think the challenges that will be faced in this region won't necessarily be a design not to do it. It'll be more a case of overcoming some of the cultural nuances which are just embedded in this local market. Thank you.
Well, thank you. And let me thank a great panel to, I think, very clearly show how Europe goes about, how, as in Gabriela's words, to bring profit, planet, and people aligned. And I think this is clearly our goal in Europe. And I think this panel did an outstanding job in conveying that message. So thank you very much. And I wish you a good conference. Bye-bye.
Thank you very much.
Thank you.